Right then, good afternoon folks, and just another update from us at the end of an extremely busy week of trading. We've had a raft of central banks out this week. We've had a bunch of data points worth keeping an eye on, but we started off on Monday. Nothing to see here on Monday. There's no high impact data on Monday, but the rest of the week did make up for that. So into Tuesday, you can see some Westpac consumer confidence figures out of Australia, which did spark some upside in the Australian dollar and has continued on that uptrend post RBA from last week with those surprise interest rate hikes, plus adding fuel to the fire that they are going to hike interest rates again in the future after they had previously said that they were going on a pause. So they've restarted their hiking cycle, deciding to themselves that they have to hike interest rates further than they initially had anticipated, which is the story of the week so far when it comes to central banks. But some positive UK labour market figures, unemployment rate unexpectedly ticking down when it was due to rise, so that means the Bank of England have something else to think about heading into next week, but we will cross that bridge a little bit later on in this video. CPI out of the US, which remains slightly sticky, certainly in the core metric of inflation once you exclude food and fuel prices. From the headline component, you can see the headline figure down 0.9% from the last month, as you can see here. Consensus 4.1, slightly below consensus, which was positive. Consensus 0.2, actually down to 0.1 on the total rate of inflation. But once you look at that core CPI print, only ticking down 0.2% from the previous month, plus in line with expectations. Now, the month-over-month core CPI print was also 0.4, in line with expectations. So inflation continuing to remain a problem, core CPI in particular remaining a problem, which Jerome Powell did allude to in his press conference on Wednesday evening. Now, the Fed did not hike interest rates. The first time in over a year that they did not hike interest rates. They began the hiking cycle in March of last year. They have hiked at every meeting since then until Wednesday. But going on a pause, a pretty short-lived pause, as in their economic projections, the dot plot did suggest to us that they were going to hike interest rates this year by another 50 basis points, when markets previously had anticipated a further 25 basis points worth of hikes, and then a pause after that. Now, that's what they have communicated to markets. Markets don't seem to want to believe it at the moment. But onto the ECB. As we can see here, 25 basis point increase in terms of the ECB, but Christine Lagarde did say that they have no intention of stopping anytime soon. They have no intention of slowing down. They have no intention of stopping. They are going to continue with those 25 basis point hikes. Even though the Eurozone did actually enter a technical recession, now a shallow technical recession, last week, they don't care. They still have work to do in order to get down the rate of inflation. So the Fed, ECB, sticking to the same script. They're going to continue hiking interest rates. Last week, the RBA, the BOC, both hiked interest rates unexpectedly. Back to the SNB, comments from the chairman Jordan last week suggesting that there was going to be further tightening in relation to their central bank. There's a raft of central banks coming in over the top and saying that they're going to hike interest rates further than they had initially anticipated and markets had initially anticipated. Onto the Bank of Japan this morning. That is the one central bank that are not doing anything. They have left policy settings unchanged again this morning, continuing on with interest rates in negative territory, continuing on with yield curve control and QE. Now, that has sparked some massive downside in the Japanese yen over the course of the last number of weeks, and that as long as this continues, as long as every other central bank continues to raise interest rates, the Bank of Japan continue not to do anything, there's got to be a reason to sell the Japanese yen. I know it's gone through the floor, but how that turns around, it's really hard to see a reason until they go and start updating things. Now, if they do start updating things, if they do remove yield curve control, or they do look to hike interest rates, that is an extremely, extremely big move awaiting you there. So that's something worth keeping an eye on. Japanese yen, if they do alter monetary policy settings, but until that point, or if that point ever comes, Japanese yen seems primed for further downside, especially when you couple that with the fact that equities continue to trend higher. You can see the S&P 500, the Dow Jones, the Nasdaq all saying to the Fed that they do not care what they have to say. There's a saying in markets, don't fight the Fed. That's exactly what markets are doing at the moment. The Fed say they're going to continue to hike interest rates. Markets are saying we don't care. You're approaching the end of it anyway. We're still gonna buy stocks now. All the you read across a lot of the financial news sources. You read about interest rates of 5.5%, 5.75. You'll see central banks continuing to hike interest rates. You'll see recession this, recession that, but that is where your technicals come in. Even the most hardcore fundamentalists, I think, do need to involve an element of technicals in their trading. You can see whatever way you try and spin it, this is not a market that believes recession is going to destroy the world. This is a market that just keeps trending higher and is enjoying the fact that that central banks are approaching the end of a hiking cycle. But the tech sector continues to keep stocks supported. Certainly the Nasdaq still through the roof, but continues to keep stocks supported. The DAX, in the midst of the central bank continuing to hike interest rates, saying that they are showing no signs of stopping hiking interest rates. The DAX is at fresh all-time highs over the course of today's session. So does it make sense fundamentally? Not quite, but does it make sense technically? The trend continues, higher lows and higher highs, and that is just where we are at the moment. And yeah, you can try and draw all the scenarios up you want about it. Are people using stocks as a slight hedge against inflation? Inflation is still high. You put money on your stocks and beat inflation, even with interest rates where they're at. They're still not beating inflation. So it's a little bit of a tricky one. People historically, when interest rates were high, they would put money into their savings accounts, and they could make a bit of percentages for them that way, and that would keep money in banks and stop money from being spent within the economy, and that would slow down an economy, that would slow growth, that would slow inflation. Now we're in a situation where that does not cut it. People put their money into stocks. We'll have to see, but the rise of AI has certainly helped keep these stock markets supported. The Nikkei is the one understandable one, with the Japanese keeping their monetary policy ultra loose, with keeping their interest rates at negative, keeping yield curve control, continuing to do QE. That makes sense. The Nikkei does make sense. I believe it's 10 weeks in a row now that you've seen upside across the Nikkei. All moves like this end the same way, but I'm not going to get drawn into that sort of analysis at the moment, as that move will probably end that same way as well, in a dump of some sort at some point. But it's like jumping in front of a steam train, that thing, isn't it? You see the way all markets are moving. Jumping in front of some of these things, probably not the wisest thing to do at the moment. US dollar over the course of this week has continued lower across the board. You can see the dollar index, but also dollar CAD, dollar Swiss, dollar yen had a bit of downside. Obviously the Bank of Japan have changed that up, but you see cable, euro, Aussie and Kiwi all trending higher, dollar block all trending higher, which means the dollar trending lower. Markets probably suggesting that all these other central banks are saying we're going to continue hiking interest rates, possibly more than what the Fed are. So maybe people think that the Fed are going to hike interest rates less than the other central banks, which would be plausible. That is likely to be the reason for downside across the US dollar. On to the economic calendar for next week. I'll have a quick flick across into next week. We got some CPI out of the UK on Wednesday. We also have the Bank of England on Thursday. We do also have the Swiss National Bank on Thursday as well. Early doors on Thursday. Now the Bank of England are going to hike interest rates. We're expected for the S&B to hike interest rates as well. But in terms of the overall tone surrounding the statements and the press conferences and the kind of chat around it, with UK inflation still at 8.7, consensus is for it to come down to 8.5. Sorry. The headline CPI print in Switzerland is 2.2% at the moment. 8.7 versus 2.2. Inflation is clearly still a lot higher in the UK. You look at the core CPI print, up to 6.8. It's still trending higher in the UK. The core CPI print, core CPI in Switzerland is 1.9. So inflation a lot higher, whatever way you try and look at it, across the UK than it is the across Switzerland. So on the balance of probabilities, you would have to expect that the UK central bank, the Bank of England, probably have to come across slightly more hawkish than the Swiss National Bank, which means looking for some sterling Swiss upside over the course of next week doesn't seem a bad way to play it. So keep an eye on that, see if you can find some upside on that. That would be my trade idea into next week. That is it from me then, folks. I'm going to wrap it up there. Have a nice weekend. Do get some rest and relaxation in, recharge the batteries, and we'll be back next week for another week of trading. Thank you.